Hi, I'm John Persinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, August 29th. Federal Reserve Chief Jerome Powell's rather stern speech last Friday can be summed up in 4 words. Don't fight the Fed. After the Fed's annual meeting in Jackson Hole, Wyoming last week, Powell strongly reiterated that combating inflation remained the Fed's top priority and the central bank would do what it takes. His remarks were rightly interpreted as hawkish and sent stocks sharply lower that day. As you can see from this graphic, Friday was a bloodbath that stopped the summer rally in its tracks. The carnage was across the board. Powell said, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation, but a failure to restore price stability would mean far greater pain. Powell added that price stability is the bedrock of our economy, and the longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. Yikes, so much for the dovish pivot. Monetary policy is unnerving investors, with the major U.S. equity indices closing in the red for the week. See the following table. International stocks slipped as well, as global investors grew concerned about the U.S. economy. As stocks sank, the 10-year U.S. Treasury yield rose above the 3.02 threshold amid renewed recession fears. Crude oil prices also climbed as supply constraints became increasingly apparent. All eyes are now on the Fed's September 2021 meeting, during which the Fed could hike rates by 50, 75, or even 100 basis points. The market has been pricing in a rate hike of 50 basis points, but we could get an unpleasant surprise. Wall Street had been hoping for signs that the inflation fight was nearing an end and the Fed would execute a dovish pivot next month, but those expectations, well, they're rapidly dimming. The U.S. dollar spiked again last week, with the U.S. dollar index reaching its highest level in 20 years. The dollar has been rising all year. A stronger greenback reflects tighter financial conditions. All this monetary policy gloominess has transpired despite the latest good news on inflation. The U.S. Bureau of Economic Analysis reported last Friday that the Personal Consumption Expenditures PCE index, the Fed's preferred gauge of inflation, eased in July as gasoline prices continued falling. In July, the PCE was up by 6.3% compared to a year earlier. That rate far exceeds the Fed's goal of keeping the PCE rising at a 2% annual rate on average over time, but it's nonetheless a slowdown from the 6.8% increase over the year through June. Month over month, the PCE fell 0.1% in July. The core PCE, which strips out volatile food and energy components, slowed to gains of 4.6% year over year and 0.1% month over month in July, coming in softer than consensus expectations on both counts. In June, the core PCE readings showed a rise of 4.8% year over year and 0.6% month over month. Because these numbers are volatile, the trend line is more revealing. The change from June was minus 0.8% at an annualized rate, and the change in core PCE was plus 1.0%. Despite these signs that inflation has peaked, Powell made it clear that the Fed still has a tough job to do. He said, while the lower inflation readings for July are welcome, a single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down. The report also showed that personal income growth for July came in at 0.2% versus expectations for an increase of 0.6%. Let's take a look at the week ahead. The highlights of this week's economic calendar are the S&P Case-Shiller U.S. Home Price Index, Consumer Confidence Index, and job openings, Tuesday. The column on the far right shows the previous readings. The latest housing sector numbers have been weak. The Case-Shiller data should signal whether housing's slide has bottomed. Chicago manufacturing PMI, Wednesday. Recent manufacturing data have shown that the economy remains in expansionary mode. Initial jobless claims, ISM Manufacturing Index, and construction spending, Thursday. Recent jobs data have been encouraging, and that trend is expected to continue. The unemployment rate, average hourly earnings, labor force participation rate, and factory orders. On Friday. How should you trade amid the uncertain conditions I've just described? If you're looking for a way to generate steady income with reduced risk, consider our premium trading service, Rapier's Income Accelerator, helmed by my longtime colleague and our income expert, Robert Rapier. Robert Rapier can show you how to squeeze up to 18 times more income out of dividend stocks with just a few minutes of work each week. For details, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Well, that's it for now. Thanks for watching.